Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, September 22nd, 2021. And our top stories today: the commercial real estate market shows resiliency and real estate remains a standard in retirement portfolios. Joining me now to discuss this and a lot more are Calvin Schnorr of NAREIT and Matthew Warner of Manulife Investment Management. Cal, Matt, great to see you. Thanks so much for joining us on the program this morning.
Thanks for having us here.
Yeah, thank you. Good morning.
Yeah, it's going to be fun. And so, Calvin, I want to start with you. Let's talk about how real estate has weathered this pandemic.
Well, there's been a huge disparity, huge differences across the property types, because some of the types of properties were really on the front line of the shutdowns, the social distancing measures, and so on, whereas others have had a real strong tailwind from this. And my comments here apply to REITs, the publicly listed real estate that our organization covers, as well as Matthew's focus on private real estate. This is a real estate issue, not a question of how the real estate is owned or managed. So we saw early on, lodging resorts, hotels, restaurants, bars, they were shut down. The tenants lost their cash flow, and that really hurt the investment proposition. Many of them were not able to pay their rents. We've seen similar thing with retail. Some of those sectors struggled quite a bit. But on the other hand, real estate also includes logistics facilities. In REITs, the industrial logistics are the ones that get the last mile delivery for Zoom purchases. They've had very strong demand. There's digital real estate, data centers, cell towers. They've had very strong demand for the electronic communications that's been going on. So overall, you've seen a lot of variation across the sectors. And the ones that had been harder hit early on last year are showing some pretty good signs of improvement right now. They're turning out.
Yeah, and Matt, I want to come to you. Cal laid out a really good case, I think more on the public side, but I want to get your perspective and Manulife's perspective on this as well. How have you seen the market perform over this, horrific pandemic?
Yeah, I think very, very similar to what Calvin alluded to on the public side that we're seeing in private. It's really it's been a real estate recovery in problem that it happened back in March of 2020. We're definitely seeing the bifurcation, industrial, given all the demand around e-commerce, that it's got some really strong, tailwinds in that sector. Multifamily also is performing very well, multifamily rentals. So we're seeing, given the home ownership and affordability issues across the country, that's, put that propensity to rent. It's just, so there's still a lot of strong demand there. As Calvin alluded to, we've seen some challenges in hospitality, retail, and office, but we are starting to see some recovery in those sectors. And we're seeing some contrarian investors start to come into those property types, and I think is kind of driving some demand there as well.
And Matt, you mentioned the return to the office, and I guess the policies are really all over the place when you look out there. Are there areas, sectors that you're looking at? Again, past performance is not the indicative of future results. We're not making any recommendations here, but when you look out into the market, and these sectors better than I would, are there specific areas that maybe stand out to you?
Yeah, and I think as we alluded to earlier, I think the primary focus has been industrial, multifamily. There's been data centers, life sciences, single family rental. It's been the primary focus. I think there's been a little bit of a wait and see on the office side until companies are fully back in the office. I think the expectation was everyone would be returning in droves post Labor Day. I think with Delta, there does seem to be that's getting delayed. We think the office, the overall office property type is going to be part of a diversified real estate portfolio. I think there's just a little bit of time where there's still a little bit of uncertainty. We just have to get everyone back in the office and get just a little bit more price discovery there. But I think long term, we think that can play a role in a diversified real estate portfolio going forward.
Matt, thanks for that. And Cal, I want to pivot back to you, get your thoughts on what Matt had to say in the office return.
Well, I agree with everything you said. There's a lot of uncertainty, but one thing that we have seen is a lot of employers are embracing a hybrid model. They're giving some flexibility for work from home when it's appropriate, but still the core, the base of activity is still in the office. And what that means is that most tenants are still going to have demand for office space. There's some who may not choose to have as much office space, but overall, most tenants are still going to be leasing the space that they had. That's a net positive for the sector once we get past the current surge in the virus.
Well, gentlemen, I want to ask you about our shows, the Broadcast Retirement Network, and I want to kind of change focus a little bit to where, and I'll start with you, Matt, where does real estate fit into a diversified portfolio for a retirement plan, whether that retirement plan is a pension plan or a defined contribution plan like a 401k, 403b, governmental 457?
Yeah, I mean, I think the primary purpose can be just part of your overall fixed income allocation. So just it can generate, income alongside some of your bond and fixed income investments. There is the opportunity for total return, as well within certain segments and strategies on the private side. I think when you look at, where real estate fits in holistically, it can be an inflation hedge in certain environments, depending on how you construct your portfolio. And in the private side, you do see a little bit less volatility than, maybe say on the public side, particularly over kind of shorter periods of time. So again, all dependent on portfolio construction and how you're diversified. But we do see, the private real estate playing a role in really a wide variety of investors' portfolio.
And Cal, I mean, we're always thinking, when you're thinking about retirement, you're thinking about the long term. And I want to get your sense for where real estate fits into that diversified portfolio someone's going to invest in, but also, is it still a good long-term investment? Because again, we're thinking about 15, 20, 30 years for a lot of people out there thinking about retiring.
These commercial buildings will last a long time, and they have long-term leases. This is a very good long-term investment. People should keep in mind when we talk about real estate here, we're talking about income-producing commercial real estate. This is not the same as owning your home. Many times people say, well, I own my home. Why should I invest in REITs? Well, owning your home does not generate income. You may get capital gains on your home, but they may be different from the capital gains that you get in REITs. If you look at commercial real estate overall, it's about a $17 trillion market. That's the third largest asset class in the US after fixed income, bonds, government bonds, corporate bonds, municipal securities, and so on, and after equities. It's the third largest asset class. And if you don't have a meaningful exposure to REITs or to private real estate through another vehicle, you don't have meaningful exposure to income producing real estate, you are missing out on diversification and possibly missing out on income. For retirees, the income is really important. REITs have a very high dividend yield. So it's an important part of a diversified portfolio for the long-term investor.
Yeah, and Matt, just to bring it back, thank you for that, Cal. Matt, just to bring it back to, we see direct real estate, we see real estate in defined benefit plans, endowments, foundations. This is really an opportunity to diversify within the defined contribution construct. Sometimes these options are not available. These real estate options are not available to participants. And to Cal's point, it can really help with that long-term income and that protection.
Yeah, exactly. I mean, I think, I think there's opportunities to be adding, private, I think the opportunities in the DC space for private is hopefully on the horizon. And again, I think, it's the possibility for inflation hedge, the diversification, it's the income piece. There is a total return aspect to it. Again, I think there's a little bit, there's some volatility, a little bit lower volatility in the private space that we see occasionally.
Yeah. And Cal, and I want to talk to you all. I'd be remiss if I didn't ask both of you about Federal Reserve interest rate policy and how it ties to real estate. Cal, let's start talking to you. Inflation, you look at CPI, you're the economist, not I, but I think general consumer inflation pretty high. It looks like the Fed could act. What does that mean for real estate?
Well, we do have low interest rates right now, and the concern is the past 6 months of higher inflation portend a longer term rise in inflation. And recently we got the CPI data, the consumer price inflation over the 12-month change has started slowing. It's drifted down the past 2 months. So we are seeing signs of what Chair Powell at the Fed had talked about, that this is probably a transitory stage. This is a transitory inflation because you got bottlenecks when The economy is opening up. It's very difficult to open everything up all at the same time. Some things you need to have a contract in place, you need to get the inventories, you need to hire the workers, you need to have the production schedules. And because that production process did not switch on like a light switch when the demand came in, we have these bottlenecks, price pressures. They're likely to be temporary. I've been a Fed watcher for 25 years. I worked at the Fed the first decade of my career, and the Fed is very committed to price stability, but they also do not see the economy overheating over the next 18 to 24 months. I think you are going to see a taper in the bond purchases going forward, and they could easily discuss interest rate increases next year. They're going to be raising the short-term rate, but that'll just bring it back in line with historical norm. The medium to long term is a very favorable interest rate environment for commercial real estate, for REIT investors, and for financial markets overall.
Yeah, and Matt, I'll close out with you, get your perspective. Obviously, Manulife, a very prominent real estate manager and also investment manager in general. Thoughts about the potential for Fed policy changes in 2021 and maybe 2022?
Yeah, I mean, listen, I think real estate's not immune, just like every asset class, in terms of what the Fed does and what the interest rate environment looks going forward. I don't, there sometimes is the perception that, with it rising interest rates, there's a correlation with, a negative impact to valuations. That can be the case. However, when you look back, that doesn't always, there is not always that direct correlation. There are other factors at play, rent growth, supply, demand, and fundamentals in the overall real estate space that really can have a bigger impact in terms of what's actually happening for income and valuation and appreciation. So again, it's an important piece, but it's not the one determining factor in terms of how your real estate portfolio will perform.
Yeah, gentlemen, really interesting discussion. We're going to have to leave it there. When we come back, we'll talk about how real estate remains a standard in a diversified portfolio. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back, and we're joined now by Mackenzie Klaus of Citus AMC and Aki Delaportis of Heitman. Mackenzie, Aki, great to see you. Thanks for joining us this morning.
Yeah, thank you, Jeff.
Thanks for having us.
Yeah, absolutely. And we're going to talk about how and whether real estate fits into a DC retirement plan like a 401k. It certainly does in pensions. But I want to get some feedback from you all. How has direct real estate and private real estate weathered the pandemic? Mackenzie, let's start with you.
Yeah. So, Jeff, I would say at the beginning of the pandemic, many funds were taking a wait and see approach, really to see what the impact that COVID-19 would have on their real estate holdings and the valuation process. But if we take a step back and holistically, there are really two indices that the private real estate market uses as a benchmark. They are the NCREIF NFI Odyssey and NCREIF NPI indices. And as of 2Q21, performance for these two indices, for the NCREIF NFI Odyssey, year-to-date 2021, they have a return of 5.64%, and trailing 1 year, so really covering the pandemic period, it's 7.09%. And then looking at the other indices, the NCREIF NPI, they have a year-to-date return of 5.37% and a 1 year trailing of 7.37%. I would say, though, performance on an individual fund basis, it's still very much a story of the haves and have-nots, and on where each fund will perform. And Aki, actually, if you could talk a little bit more on specific property type performance, that would be great.
Yeah, sure. Mackenzie, you're absolutely right. Certain property sectors fared better than others. Industrial, for instance, benefited significantly from e-commerce activity, driving demand in the broader space. Investors piled into this asset class, capitalizing on rising rents and in a low capital intensive asset class. We have observed record pricing, virtually all segments of this sector, with the greatest yield compression in last mile property types. Investor demand has been the highest for coastal assets, but we're now seeing that expand into interior regions, given yields have increased or decreased significantly. There's also been significant rent growth over the last 12 months, especially on lease trade outs, with some approaching double digits. Apartments and other darling during the pandemic. There were some concerns at the onset, especially due to the lockdowns and some industries slowing down. There were concerns about rent collection rates, but stimulus programs and increased unemployment support helped keep collection rates from moving in the wrong direction, which was great. The job market also bounced back very quickly post-lockdown. As you know, that's the story on the news. There's no shortage of jobs currently. And it's really been a tale of two cities, Gateway versus Sunbelt, urban versus suburban, high rise versus low rise. Sunbelt markets have been on fire. The remote work has allowed workers to migrate to warmer cities and lower cost markets. As a result, gateway apartment markets like San Francisco were hit the hardest during the pandemic. With the exception of gateway markets, most rents have recovered, with some markets observing 15 to 20% new market lease trade out rates. And national occupancy and rent growth rates have never been higher. Self-storage.
Yeah, go ahead, Aki.
Go ahead, Jeff, after you.
I was going to make the analogy that I know my rent, we just renewed our lease, our rent has gone up here in Charlotte. So it's good to see that there's been a recovery. Mackenzie, I want to talk about the purchasing of real estate assets. And both you and Aki, both of your firms work with endowments, foundations, pensions, DC plans. Have you seen them continue to purchase real estate assets for their particular programs?
Yes. Sorry, Aki, do you want to take this one?
Yeah, absolutely. Our clients have a consistent need to diversify. And so there's a rebalancing that needs to occur on a recurring basis. We've actually observed some clients increase their allocations to direct real estate, in part due to concerns about inflation. Generally speaking, second quarter of 2020 screeched to a halt, very little activity. But since then, it's picked up significantly. Industrial, apartment, all of it in very high demand. And some of the other trends we're seeing is within the apartment sector, value add properties have also increased in demand as investors chase some of that yield, just given the fact that, you know, some of the core properties are have the lower yields. You know, retail and office, I think generally speaking, have been shied away from. The self-storage is one of those asset classes where new capital is chasing significantly. Another one of those asset classes that is performing very well post-pandemic and at record highs of market lease rates and occupancy.
Yeah, I would add to that as well. So as Aki mentioned, on the valuation front, from transactions that we are seeing for industrial, like you mentioned, it's very much the coastal industrial assets are the ones that we're seeing that people are gravitating towards when it comes to transactions. And then for apartments, it's really that Sunbelt, like he mentioned, Sunbelt, the Southeast is really where everybody's gravitating towards. On the retail side, transactions, we are seeing a little bit of activity, but it's really on those high quality grocery anchored retail assets. And then office, there's a little bit, but office is still one of those the asset class that people are really taking a pause on and just waiting to see what happens.
And that's driven largely due to the fact that, you know, companies have yet to develop their workforce strategy post-pandemic, and this is something that's going to unveil itself over the next few years.
Yeah, I think you see them kind of announce it, then they walk it back. I think that like you're right. I think it's yet to be determined how that will kind of flesh out. Guys, let's talk about where private and direct real estate fits into the DC plan and is it part of a diversified portfolio? Who wants to take that one?
Yeah, I can start, and Mackenzie, feel free to chime in. You know, private real estate fits into a professionally managed asset allocation fund in the same way that it would fit into a defined benefit pension plan. It's really diversifying your portfolio. This can be in a target date fund or a target risk fund within a defined long-term allocation strategy. And there's several reasons supporting that. One is, you know, you have low long-term correlations to other major asset classes like bonds, equities, which provides diversification in your portfolio. There's great stable income return. It's the largest component of the total return, driven by a private real estate investment. And generally speaking, a direct real estate investment will reduce volatility without sacrificing returns. And commenting on what I said earlier, inflation protection, you know, direct real estate has historically outperformed during inflationary times.
Mackenzie, anything you want to add there?
No, Aki covered it.
He nailed it. But let's talk about one of the important pieces. I think a lot of plan sponsors, people who are sponsoring 401k, 403b, governmental 457b plans, those are daily valued plans, right? That every day they're typically mutual fund structures, and they derive an NAV, a net asset value, and price the particular fund or that participant's account. How has private real estate been incorporated in DC plan, and what's the evaluation process like for these types of products?
Yeah, I can start with this one. And I think it helps too if we take a couple steps back. So as part of DCREC, we have established key principles for daily valuation of private real estate funds. And these principles provide structure yet flexibility to help meet the needs of all of these various funds when they're trying to be daily valued. And as part of our review of these guidelines, last year we actually did conduct a survey of the private real estate funds that offer daily valuation products. And the survey was asking, their adherence to these guidelines that were established within DCREC. And as a result of the survey, we found that 100% of the funds do adhere to these key principles that we did establish. Examples of these principles include engaging a third-party appraiser to value the real estate holdings, as well as overseeing the valuation process, recognizing material events on a timely basis, recognizing the income and capital return of your real estate and or debt holdings, and really having an established process and procedure in place for valuations in general. And then also considering your other assets and liabilities that you may have, including your partnership interests. Overall, our goal with this was to have our principles in place to help increase transparency, objectivity, integrity, and consistency across these types of products.
Yeah, and guys, before I let you go, I want to talk a little bit about ESG and sustainability. It's a hot topic, not only in defined contribution plans, but across the investment spectrum. How does ESG and sustainability and impact investing get incorporated to the real estate process?
Yeah, investors are looking for investment opportunities that mirror their own beliefs. And many private real estate managers, as a result, are focused on ESG, both to appease investors, but also to seek out new areas of risk and opportunity and impacts in their portfolio and assets. These managers will utilize ESG optimization strategies, which can include performing energy audits, mechanical systems, investing in energy efficient lighting. From a social perspective, they may perform interviews of their tenants to understand what their concerns are, and addressing those concerns will create stickier tenants and reduce downtime and turnover, and thereby improving performance. So these are all aspects that we're uber focused on within the private direct real estate industry. We're heading into hurricane season. Climate risk is a significant risk. Can lead to higher utility costs, maintenance costs, insurance bills due to weather-related disaster claims. Investor sentiment around climate risk has really increased significantly. It's really critical to the process. You want to make sure you fully understand what the risks are, so that you're not penalized today, 2 years from now, or 10 years from now after you look to exit a vehicle or real estate investment.
Yeah, it really is fascinating to see all the things that are going on socially and how they get infused into the investment process. And I guess real estate is no exception to that rule. Mackenzie Klaus, Aki Delaportis, thank you so much for joining us on the program this morning. I wish you the best for the rest of the week, and we'll talk to you again very soon.
Yeah, thank you.
Thank you, Jeff.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.